Yesterday, California Resources Corp, an energy company, filed Chapter 11 bankruptcy. And Chapter 11 is when you file bankruptcy, but you continue to operate and you try to renegotiate the terms of your debts and other financial obligations. So it doesn't change the day-to-day business, but major decisions have to go through a bankruptcy court. You can make a lot of money when a stock goes down, just like you can make a lot of money when a stock goes up. If you would have shorted the stock, even in the beginning of the year, they were $7. Now they're down to $1. So you could have made a massive return. Imagine going from $1 up to $7. That's 700% return. It's the same thing as going from $7 down to $1. I did a video on how to sell Tesla stock short as an example. I'll link it in the description. You can also sell call options or buy put options if you want to short a stock. If, for instance, in January you bought a put option that the stock will go down in February, but you could see it didn't really go down, it's level, you wouldn't have made any money. So there is a time sensitivity with options. You have to time it right. So if you sell the stock short, there's no time sensitivity in it. You do have to pay interest on your margin account. That's the only risk with the time delay. But you can hold the stock for 6 months or a year and wait for it to go down. So how do you know when a stock price is going to go down? Well, I guess it's just as hard to figure out when a stock price is going to go up. You have to look at the financials and try to figure that out. The company has been talking about it in the news a little, how they're struggling and they may end up filing bankruptcy. That is one sign, but generally when it's mentioned in the news, the stock price is already priced in and it's already at a low point. The article says, while the announcement was not entirely unexpected, it had been reported CRC was planning a bankruptcy filing and the company warned in May it might not survive. So if you look at the stock in May, it was already priced in, so you probably wouldn't have benefited too much unless you caught it on this upswing around $2.50, $3, and you would have made a buck on it if you timed it right. But generally you'd want to catch it before it's reported in news when the stock is still high, because once they report it, everybody knows about it and the price is low. The reason companies file bankruptcy is because they can't pay the interest on their debt. The article says the bankruptcy filing is expected to allow Santa Clarita-based CRC to continue operating while it puts behind it the financial struggles that caused it to miss multiple deadlines recently from making $30 million in interest payments. So you can see the article mentions it was struggling to pay the interest on its debt, and that's generally why companies go bankrupt. They just can't pay the interest on their debt. So why take any debt at all? Well, if you want to grow your business, you probably need to take on debt. And it's also a lot cheaper way to grow your business. It's cheaper than equity. There's lots of risks with debt. In this case, if you can't pay it, but also if interest rates do go up, your interest payments are higher, and it just pulls a lot of money out of the business, interest payments. That money could have went towards growing the business or doing other things. So what I generally do in the videos I make is look at the financial information of the company to try to figure things out. So let's do that, and let's see if we could have identified something in their financials that would have indicated they were going to go bankrupt before everybody else figured it out. So the 12/31/19 financials came out well before the announcement by the company that it may go bankrupt. So you could have identified they might have been heading that direction and possibly profited off their demise. So when looking at financials, it's like a puzzle and you have to put all the pieces together, because any one situation, like if you look on the balance sheet and they have negative equity or they have a really bad PE ratio, you can find dozens of companies that fit that criteria and they're not going bankrupt. But when you put all these negatives together, then it could lead you to the direction that the company could be headed towards bankruptcy, or at least struggling unless they turn things around. So keep that in mind. Don't just focus on one thing and say, oh, in 2019 they had negative net income, so they're a bad company. Or in 2018 they had $328 million of net income, so therefore they're doing fine. No, you have to put it all together, which is really confusing because, like, how do you know what is more prominent than what other ratio or statistic? It just takes a lot of time, and also, like, certain industries, you need to focus on different things, and we're all learning. I'm learning, you're learning, so we're gonna all learn together. So let's look at the income statement, balance sheet, and cash flow statement. It would be good to delve into the 10K, although it's really hard to do on a video, and I probably will do it in the future, but for now, let's just stick with the Yahoo Finance because it's a lot easier to show on a video and talk about. So let's look at the income statement. So looking at 4 years of financial data is more than appropriate. You don't have to go back 10, 20 years. It might have been a totally different company at that point. So their revenue was $1.8 billion in 2016, and it grew in 2016, and it grew again in 2018, but then it dropped in 2019. It looks like the trailing 12-month number is going to drop again, but that's mainly because oil prices have come down so much, and that's why their revenue has come down too. But that's a big reason they filed bankruptcy with low oil prices. They just couldn't bring in the revenue to pay their expenses. The cost of revenue seems pretty steady. You want to look at everything as a percentage. So let's look at everything in relative to the revenue. So cost of revenue over total revenue. That's 55%. Let's copy that across here. And let's lock the total revenue cell so we can copy it down. And you could skip the video if you don't want to see all these steps, but I just want to show you how I'm doing it in case you want to replicate it yourself. So the cost of revenue is kind of like cost of goods sold. It's the cost to operate your regular everyday business, which are different than operating expenses. And I'll try to explain more in a minute. So cost of goods sold probably is like your inventory and things that you really need to run your actual business. Sometimes payrolls include in cost of goods sold, sometimes it's included in operating expenses. We need to look at a 10K to figure that out. But let's not get too focused on that. The gross profit is the revenue minus cost of revenue. That's just the difference between these two numbers, the 2.4 and 1.3. And then there's operating expenses, which are probably payroll, rent, things like that. And then the operating income or loss is total revenue minus cost of revenue minus operating expenses. So these two in gray are your expenses to run your business. And that's the what you generate for your business before you pay interest and taxes. So let's look at everything on a percentage basis. So cost of revenue in 2016 was 78%, and that's the 1.3 billion right here over the 1.8 billion. Yahoo has numbers in thousands, so that's why I'm saying billion, even though it says million on the screen. The percentages or margins, as some people call it, should improve as your revenue increases because of your fixed costs. They don't change when your revenue goes up. Variable costs do change, like payroll and inventory. So their cost of goods sold margin went from 78% down to 55% because their revenue was increasing and they were covering their fixed costs. So that's good. Their gross profit margin has improved as well. It went from 22 to 45. And we'd want the profit margin to increase. But the cost of goods sold, we want it to decrease because this is expenses. So we want the percentages of expenses to decrease. So that's good when we see these things. The operating expenses are pretty static. It goes from 28 to 30, even with revenue increases. So there might be mostly variable costs inside the operating expenses. I don't know how they break out the cost of goods sold and operating expenses. We'd have to look on the 10K to figure that out. But apparently it looks like the fixed costs are in the cost of goods sold because those are changing the percentages, and these are more variable costs. Usually operating expenses include mostly payroll, which makes sense why it wouldn't change too much, because the more money you make, generally the higher your payroll becomes because you need more employees. Their operating margins seem to have improved also. They went from negative 6% to 7% to 25%, then dropped a little. But their net income margins are kind of all over the place. Net income is different than operating income. Operating income is just the money that's left over after operating a business, but before you pay interest and taxes. So net income is after interest and taxes. And this is right here. That's like the bottom line of your income statement. You can't get that much of a read looking on the income statement. The income statement, although it's important, I think the balance sheet is more important because that shows you the actual health of the company. The income statement can be a little confusing and misleading because they use accrual accounting, so it might not look like the company's in that bad shape. But when you look at the balance sheet, you should get a lot more information. But if you do look at the negative 1.8 billion of trailing 12-month net income, that's an obvious red flag that something's wrong. The big drop in oil prices didn't happen years ago. They happened fairly recently. The balance sheet is a better indicator of the health of the company. It's kind of like looking at your total assets, like how much cash you have, how much money you have investments, how much credit card debt you have, how much mortgage debt you have, and that gives you a good sense of your likelihood of being able to pay your bills and going into default. But if I looked at your W-2 from last year and how much money you made, that wouldn't give me too much information on like whether you have money or not. So as you know, the balance sheet is assets equal liabilities plus equity. So you want more assets than liabilities because it's kind of like saying, do you want to have more cash in the bank and more investments, or do you want to have more credit card debt? Of course, you want to have more cash and investments. But if you have more credit card debt, if you have $100,000 in credit card debt and only $20,000 saved in the bank, you're probably not in the best shape. But if you flipped it, you're in good shape. Let's delve into the balance sheet. Total assets is $7 billion. That's what the company owns. And that's broken down into current assets and non-current assets. Current assets are generally assets that can be liquidated into cash within 12 months. And the best current asset is cash. And it usually starts with the most liquid to the least liquid. And cash is by definition liquid. So 17 million of cash, not a lot of cash. So net receivables are accounts receivables, which is what people owe you, minus what you don't expect to receive from those customers. So if you have 300 million of receivables, for example, that means customers owe you $300 million for products you provided to them or services you provided to them. But you have to also report on your balance sheet what you don't expect to receive, because you're not going to receive everything. So they have $67 million of inventory, which are just products they have in their warehouse or factories that they're planning to sell to customers. Other current assets are $2 million. That's a pretty low amount. So 491 million of current assets. And current assets are better than non-current assets because they're more liquid and you can turn those into cash a lot easier. And according to that 2019 balance sheet, they had 23 billion of property, plant, and equipment and 16.5 billion of depreciation. So to get the net of those two numbers, that's your non-current assets. So the way that works is, to explain how depreciation works on a balance sheet, let me just give you a simple example. Say in 2015 you bought a machine. In this case, it's for extraction of oil, because that's what they do, for $1 million. And you know, as time goes on, the machine depreciates. The value of the machine gets lower and lower, and eventually it's worth nothing. So they report the $1 million in their balance sheet as property, plant, and equipment, and then they depreciate it, say zero, because they bought it on day one. They don't have to depreciate it. So it increases their assets $1 million in 2015. But in 2016, the machine, they keep it at $1 million, but they depreciate $100,000. And you could use different depreciation methods, and that's a really interesting topic, and I don't want to get into that because that could be a little confusing. I would like to make a video, but let's just keep it simple. Say they use a 10-year straight line depreciation. So in the first year, they depreciate the asset $100,000. So that's 10%. So now this particular machine increases their assets to $900,000, not $1 million anymore. And then in 2017, this machine, they keep the $1 million on property, plant, and equipment because that's a gross amount. The depreciation is negative $200,000. So this machine adds $800,000 to its balance sheet. So this is a clearer picture of a company's assets if they depreciate, because if you buy something like a car for $50,000 today, 10 years from now, that car is worth like almost nothing. So you can't keep it at $50,000 forever because it's just really deceiving. So when you depreciate assets, it gives investors like us, and it also gives like banks, because banks need to look at their balance sheet too to see if they lend to these companies. It gives a clearer picture of the health of a company. So the gross property, plant, and equipment was $23 billion. So possibly this machine for $1 million is part of it. It's just one of many things in gross property, plant, and equipment. And then the depreciation of the $100,000 a year is also part of it. It's just mixed in with so many other things. You cannot count the $23 billion as an asset. You have to minus the depreciation, and that's why it comes out to $6.3 billion of property, plant, and equipment. And that's the value it adds to its balance sheet. So pretty much all their current assets are property, plant, and equipment. A good idea as an investor is to look on a 10K and look at these assets and look at how much they've been depreciated, and you might make a decision and say, some of these assets I don't think should be depreciated as much as they have been. So I think the balance sheet is worth more than they're saying. That's probably not going to be the case, but in some cases you might say, I think these assets are crap. They're actually worth nothing. So even though they're reporting $6.4 billion, I think that's closer to $3 billion. So making your analysis using the correct information, that's hard to really figure out, but it just takes time to learn these things. So they have $7 billion of assets and $7.3 billion of liabilities. That's like saying, I own my house and my mortgage is $250,000, but my house is actually worth $200,000. That's not good. You're upside down in your mortgage. That's kind of like their situation. They're upside down. They owe more than they have. And you may have bought the house and it was worth $400,000, but over time, now it's worth less. That can happen. But most of their debt is this long-term debt of $4.9 billion. If you watch my videos, that means it's debt due after 12 months. But if you looked at the 10K, you would see the debt matures in 2021, which is after 12 months according to this, because this is as of 12/31/19. But that's still right around the corner, about 2021. So you want to look to make sure the debt isn't due within a year or two, because if it is, it could smell trouble for the company. If it's due in 6-7 years, they have a little time, a little room to breathe and wait for oil prices to increase. So that's a big red flag. They have negative equity in the balance sheet. Their liabilities are more than their assets. There are some really strong companies with negative equity. You just have to look on their balance sheet to look at their actual assets and liabilities and understand their income statement to figure that stuff out. So this is a big red flag that can lead you to the direction that they might go bankrupt. And you can see they have positive free cash flow, so you might think they're in good shape, they're healthy, but you have to look at other factors, and also the decrease in oil prices has really affected this company. I think we'll end the video at this point because I don't want to go too much deeper into the analysis, although I think it's helpful. I just want to make the information understandable and easy to digest. And each time I see a bankruptcy, I want to do this similar analysis, but go a little deeper each time so you're following step by step with me, assuming you watched the previous videos. So thanks for watching.